Hello, Bitcoiners. Welcome back to Bitcoin Daily News. Strategy. Again. Every single week, the fear, uncertainty, and dread around Michael Saylor's treasury has spiraled so far out of control that half of the Bitcoin world will not move on. Well, we are. Today, we take every line of FUD head on. Stack exit, death spiral, hypocrisy, the whole feed. We run it against what the company actually filed. We dissect the factless bears. We separate what strategy owes its preferred shareholders from what you actually hold. And when we are done, we lock this topic in cold storage where it belongs. Welcome to episode 1 of End the FUD. Strategy still holds more than 844,000 Bitcoin. This week's sale was less than 4,000 coins. The liquidation story does not math. I'm Danny Satz. Pull up a chair. The Bitcoin chain does not grade corporate balance sheets, but we will. Once, and then we move on. So let's cover what people are actually afraid of. All of it. Because pretending half the fear does not exist is how panic spreads. The stack exit has begun. Strategy sold Bitcoin. And this week was the largest sale in its 6-year hoarding history. Headlines called the pace dramatic. The dividend machine is eating its own Bitcoin. High-yield preferred shares need cash every month, and every coupon is another reason to tap the vault. The death spiral story is alive. Falling stock price makes raising capital harder, which forces more coin sales, which scares preferred holders, which widens spreads, which forces more sales. Some writers have compared it to the old stablecoin collapses. Others point to reserves that only cover a few months of obligations. Math that sounds terrifying if you have not read the June framework. Then there is the paper loss. More than $8 billion unrealized in the second quarter. Bitcoin trading below what strategy paid on average. Bears say the next step is bankruptcy selling, the kind that actually moves supply. Then there is Saylor himself. For years, he told everyone, never sell your Bitcoin. Hold it forever. Now, his company is selling coins to pay preferred dividends. A lot of people hear that and say he lied. The public story was keep stacking, and the private reality is moving coins to keep the dividend machine running. Then there is what it does to the market. JP Morgan warned that the world's biggest corporate Bitcoin buyer might also become a seller. Two-way flow risk in a fragile market. The Motley Fool said one holder sitting on 4% of all Bitcoin that will ever exist is concentration risk whether you like the company or not. Then there is the stock. Strategy shares traded for years above the value of its coins. Lately, that premium has disappeared. The whole playbook, issue shares, buy Bitcoin, grow the stack per share, looks broken when the market prices the company below the vault. And there is the million coin question underneath all of it. If they are selling to survive coupons, the march to 1 million is over. Now, for anyone listening, it is all right to be afraid. Some of these claims are reasonable. It is a fact that the largest corporate holder of Bitcoin is changing how it runs its business, and it's doing it in a bad year for price. So let these fears have their moment, a place in the conversation, and a pause to sit with them. Now let's change perspective and, starting out, look at what the company actually filed. Strategy's own purchase tracker still shows 844,000 coins. The sale was fewer than 4,000. That is not half of 1% of what they still hold. Picture a swimming pool and a coffee cup. Fortune's largest sale ever and CoinDesk's dramatic pace are measuring the coffee cup. They are not measuring the pool. The company said the dollars went where they said they would go: preferred dividends, refilling a cash reserve near $2.5 billion. The reserve is the gas tank for coupon payments. It is not the engine. The engine is still the coin pile. On the stack exit fear, look at direction, not just 1 week. 2026 has been brutal for price, and strategy still added tens of thousands of coins net from January through this report. They sold a small slice in July. They did not unwind the position. In fact, if you run the numbers on the month, something awkward shows up for the exit narrative. The company bought thousands of coins in June, sold thousands in early July, and ended up net positive on the stack. A real exit looks like marathon-style capitulation or a horde bleeding quarter after quarter. This looks like plumbing on an enormous balance sheet. The June framework laid out the cash picture in plain terms: $2.5 billion in reserve, board authority to sell coins for more than $1 billion additional if management chooses. Put together, the company described more than 2 years of preferred dividend runway at current rates. Blockhead's own piece this week admitted the tension is not the sale itself, it is what the sale reveals, and called that a feature of the model, not a crisis, hidden while Bitcoin kept rising. Death spiral pieces that cite only 6 months of reserve are using stale math from before that framework. The filed package is 26 months when you count the reserve plus the unused monetization ceiling. JP Morgan asked for 24 to 36 months before investors relax. The company landed in that band on paper. The July week drew down roughly $216 million. The ceiling is still mostly in the drawer. On the paper loss fear, the multi-billion-dollar quarterly loss is real on paper and mostly unrealized. Bitcoin traded below what strategy paid on average. Accountants mark that down. The coins did not disappear. Your cold storage did not shrink because a public company took a write-down. Crypto Briefing is right that they sold below average cost this week. That is an accounting and signaling fact. It is not proof the vault is empty. Confusing a spreadsheet with a fire sale is how liquidation FUD spreads. And on the wrapper stress, Strategy's premium to its coins was the permission slip to issue shares and buy more Bitcoin without hurting existing holders. Compression is painful for anyone holding MSTR. Saxo's bear case is fair for the equity. The old gearing thesis is stressed. It is not the same thing as the treasury running out of Bitcoin, though. Stress on the wrapper and stress on the stack are related cousins, but not twins. To make sense of why a public company can sell a few thousand coins and still be net long for the year, it helps to remember what strategy actually is at this point. It is not a software firm that happens to own Bitcoin. It is trying to become something Michael Saylor has started calling a digital energy company. Bitcoin on the balance sheet is the long game. Today, the operating layer is still mostly fiat. Preferred dividends pay in dollars. The reserve sits in dollars. Bondholders and preferred holders think in coupons and coverage ratios, not satoshis. You can believe that it is the wrong design and still see why the company cannot pretend the fiat layer does not exist while it builds. The other half of the model is digital credit. Strategy issues high-yield preferred shares with names like STRC and markets them as a new kind of credit product backed by a Bitcoin treasury. In the June 29th framework filing, the board said the whole package was meant to strengthen those securities, keep liquidity visible, and preserve long-term coin exposure. Michael Saylor said in the same release that digital credit requires liquidity and discipline, and that the framework was designed to strengthen credit quality. The filing also says management will reset the STRC dividend rate month by month while watching market yields and credit spreads. That is the company telling credit buyers, we will run this like a borrower who can pay, not like a museum that can never touch the collection. And here is where Saylor upset the pure never sell crowd, and where the hypocrisy fear deserves a straight answer. At the BTC Prague conference in June, speaking to Cointelegraph, he argued that a Bitcoin treasury company issuing credit products must keep the option to sell. His line was blunt. If the policy is that we never sell Bitcoin, then the credit has no value and the equity has no value. He told individuals to hold bearer Bitcoin. He built a public company to run a digital credit machine. Those are two different products. The audit question is not whether the rhetoric rhymes. It is whether a coffee cup sale from a swimming pool is a treasury unwind. The filing says it is not. That is a corporate finance argument, not a statement about your wallet. A coin pile that can never be tapped when coupons come due is a locked display case to credit markets, not collateral. If investors think the only exit is diluting common stock forever, preferred shares trade worse, spreads widen, and the machine that buys more Bitcoin gets pricier. A thin slice sold on framework terms is how they signal the pile is real. Chief Financial Officer Andrew King said the same thing in boardroom language. Bitcoin is capital, and monetizing some of it can strengthen digital credit when that beats issuing more common equity. So when the July sale hit the wire, the bear read was hypocrisy. The company read was machinery at tiny volume, dollars to dividends, gas tank refilled, stack still enormous. Peter Schiff's line that strategy cannot sell without crashing Bitcoin got a live test this week. Bitcoin did not collapse on the headline. The Motley Fool's concentration worry is fair at scale. 4% in one wrapper is a lot. Their conclusion is also worth hearing. Even telegraphed sales under this framework are not a thesis breaker for Bitcoin's fixed supply. The worst scenarios largely played out in the equity without the network changing its rules. Think of the unused sale ceiling like an insurance policy, still mostly in the drawer. Strategy also tracks BTC yield. Did the stack grow per share faster than shares outstanding? So far this year, yes. That is their scoreboard, not yours, and it is still points up. So what does this mean for the million coin question? And for you, if you never bought a share? The million headline is real as ambition. Michael Saylor has talked about owning a large fraction of all the Bitcoin that will ever exist. On a round read, 844,000 is about 85% of the way to 1 million. Roughly 156,000 coins still to go. That is a long march, not a weekend sprint. Public slide paths and media headlines do not always agree on the calendar. The honest listen is simpler. They are still buying on net in a bad year. They are not liquidating. Whether they close 1 million coins on your timeline is a capital markets bet, not proof that coins vanished this week. For self-custodied holders, the separation is the whole point. Strategy can sell 4,000 coins to pay a dividend because its credit products live on the fiat layer today. The network still issues 3.25 Bitcoin per block on the same schedule. Your stack does not get a haircut because a corporate treasurer moved a coffee cup from the pool. Saylor's zero value line is about MSTR and STRC, not about Bitcoin and your cold storage. Another entity holding more coins changed who owns what. It does not mint new supply. One more mechanism worth hearing because bears treat STRC like a lien on the vault. Strategy's own disclosures say those preferred shares are not collateralized by the Bitcoin pile. That is normal. Preferred stock almost everywhere works the same way. It's a claim on the company, not a deed to a specific asset in the vault. Nothing about that changed just because the asset happens to be Bitcoin. When a firm sells a slice to pay a coupon, it is not stripping collateral from those preferred shares in the way a margin call strips a house. It is moving dollars through a capital structure you never bought unless you bought the preferred stock. Then there's the bond cliff fear. This is the idea that strategy owes so much that one bad quarter forces a fire sale of the whole stack just to stay alive. The next time the company faces a large bond payment that actually matters is not next month. Analysts who follow the stock put it years out, around 2028, roughly $1 billion. That is real debt on a real calendar. It is also not a gun to the head this quarter. A bad earnings print does not mean 844,000 coins hit the market next week because a bond came due. And on the dividend math, Saylor has said something surprisingly small on earnings calls. If Bitcoin merely appreciates a few percent a year, near 2 to 3%, the Treasury can cover preferred obligations without constantly tapping the pile. Bitcoin's long-run history makes that sound modest. This year's price does not, but the company is not one missed coupon away from emptying 844,000 coins. It built a gas tank, a sale ceiling, and a credit story for exactly this friction. So to sum it up, 844,000 coins are still there, fewer than 4,000 sold, more than 2 years of dividend runway on the framework math, tens of thousands added net this year, and about 156,000 to go if 1 million is the finish line. That closes episode 1 of End the FUD. We will run a panic story through the filings once and then shelf it. Unless the math changes materially, you will not hear this liquidation loop again every time a preferred dividend clears. We will still note big treasury moves when they matter. 2 earlier pieces on this channel sit on the same thread if you want the build-up. The June 30th piece walked what the board authorized on paper. The June 8th piece walked the first tiny sale, 32 coins, and why the signal mattered more than the size. Both are linked in the description. Take care out there. See you in the next story.